Karn, welcome to the show. Good to have you.
Yeah, thanks for having me, guys. Appreciate it.
Absolutely. Thanks for coming on.
Looks like a busy traffic day out there behind you.
San Francisco.
Oh,
Nice.
yeah. Well, Karn,
Good,
we've been quite a bit focused on sort of the for a while. Andy and I were very deep into the technical side of this world. We dig into blockchain architecture and these sorts of things. More recently, we've been focused on the financial elements here, and that has been talking about more hyperliquid today and sort of the near intense model today. But there's a very strong fundamental thesis around the financial elements of something like the reinsurance market as well. We were also in Bermuda for the SALT conference. There was very strong insurance markets there. So I'm very excited to hear a little bit more about RE and how you guys are making an impact on this market. Before we dig into RE and reinsurance, maybe just a little bit about your founder background and how you ultimately ended up founding RE.
Yeah, for sure. I mean, I've been building businesses since my mid-20s. Ended up at Shopify pretty early on. Joined Y Combinator about a decade ago to start an insurance company called Cover. Bought reinsurance as kind of part of that process, and then decided to start a reinsurance company. So if you guys aren't familiar with what that is, I run an insurance company for other insurance companies. We quite literally are kind of like the capital lake or the ocean that insurance companies, which are the boats, sit on top and kind of use us as a source of capital.
Yeah, beautiful. And I mean, one of the things that the market is reacting well to, Karn, is making money, and you guys have a very, very solid business. Can you maybe just explain how the business side of reinsurance works, specifically with what you guys are doing at RE Protocol? And then kind of tie in like why being on chain or why having kind of like a DeFi aspect to your business contributes to kind of like the grander vision here.
Yeah, for sure. Look, I think if you unpack when you buy an insurance policy, what are you buying? You're buying a promise, right? Something happens, you get paid out. The counterpart to that is there has to be the capital there for the claim to be made or for people to trust that you're going to fulfill your promise. That's the basic premise behind any insurance business, and it is most elegantly represented on chain, right? So anyone in the world can see exactly what capital we have, what our solvency position is, that we're good for all the promises that we make. And that is particularly effective when you're talking to insurance company customers who rely on you for that capital, and to regulators who are looking at you to be sure that you're meeting your solvency requirement, that policyholders are not going to be left in the lurch, and that you can kind of continue to scale in that regard. So we thought of it as the most elegant way to build a reinsurer completely transparently, and then building this new plumbing into DeFi that takes in stablecoins, funnels those stablecoins to insurance companies that are regulated, and those insurance companies go out into the broader world, sell insurance policies to every conceivable business, person, and entity that's trying to conduct commerce or engage in the real economy, right? And so that's quickly my journey today. We are at about 410 million in total book. We touch 700,000 policyholders across the United States. So we're in the background, we're the plumbing. We're probably of the most size and scale that at least with real world impact, that most RWAs or DeFi protocols have not yet touched. But it is really meaningful. People can get to work because of us. People can buy homes because of us. People can start businesses because of us.
And Karn, could you describe why it's helpful to have the reinsurance market on chain?
Well, it's the transparency, right?
Yeah, it's actually also an act of coordinating capital and capital flows, right? So if you think about the risks that are being taken in the real world, those need to be matched up to capital, one, in a transparent way. But that plumbing, there's really nothing special about the capital. Like capital can form in a unique way like it does on chain. But this is a repeatable process that should be readily observable by anyone in the world. Like if you have a computer, you should be able to say, hey, there's this massive lake of capital that supports all real economic activity, right? And so that, primarily the most elegant thing. But if you pare it back even further, this is a space that has not been the most adoptive of technology. Super conservative, very regulated. A lot of the business gets conducted over email, phone calls, brown liquor, spreadsheets. And so if you're thinking about how do you get to a point where you just build this machine that is able to accurately price risk and enable risk taking, you need to be able to get all of insurance and reinsurance on chain. So that's like you sell a policy, you capture information, that information percolates all the way down to the capital provider in kind of the most elegant technology forward way possible. Get better pricing, get better underwriting, get better results. You completely refactor this business, and it's trillions, right? It's non-trivial.
Yeah, and so you guys have you said about $410 million on the book right now.
Yeah.
Kind of looking to continue to grow that. What does that mean from the business perspective? Like, what is the value capture of a $410 million book? And then what happens as you guys scale, into the billions for this reinsurance company?
Yeah.
What is that? How does RE Protocol, the company, capture value? And this will lead us into, token and thoughts on, creating a sustainable business on chain.
Yeah, for sure. So the protocol itself, the right mental model is Lloyd's of London. Many of you may not be familiar with that, but it is a massive insurance marketplace that exists in London. It's 350 years old. It is a pot of capital. It's an institution that has licenses and infrastructure. It enables certain counterparties to trade in that market. It has 72 different insurance companies and underwriters that kind of transact there. The right mental model for re is that. Like, while we own a reinsurer, the protocol itself is intended to be, hey, you pool this capital, and now you can point this capital at any insurance company in the world. That is a massive idea. That's trillions in premium that could be flowing and economics that are generated to underlying depositors, right? And you can do it most elegantly now and quickly now because we live at this unique inflection point where the technology exists for this to happen. So then it becomes a really, really interesting and unique kind of business development effort, right? And so now we're kind of starting to win this war for on-chain capital that's coming in and we're sourcing. We're also starting to win this war on human capital. So like the top underwriters, the folks who are most forward-thinking in the insurance and reinsurance market know that on-chain and digital capital is the future, especially in a market where you need to prove solvency, you need to prove that you have the capital, and others need to be able to trust you because the product is this trust. And so we're starting to win that, and those folks are bringing business in, right? And so now you're seeing multi-$100 million accounts come our way. You're seeing all sorts of new insurance companies at the cadence of like one or two every 1 or 2 weeks join the network, and start to buy reinsurance from us today. We're whitelisted now with practically every major reinsurance broker in the world. So Guy Carpenter, Aon, Gallagher, all of these guys who transact incredible amounts of this business now point some of this business towards us. And so it's not, out of the question, we've got $410 million on the books. For new business this year, we're already at about $230 million, right? We had set out a year-long target of 400, which is a stretch. We're going to handily hit that, and we're likely to exceed it, right? And so now it's just a question of, can you kind of continue to pummel on capital formation? Can you get the smartest people in this market, both on the technology side, DeFi, as well as the folks who have been doing this and running multi-billion-dollar books of reinsurance business kind of involved? And I think we're doing a really good job of both.
And as you continue to scale this business, one of the conversations that we've had significantly on the show, it feels like every day, is where that value accrues. Like, the decision between sticking in the equity game or kind of launching a token and distributing more of that value out into your network. What goes through your mind as a founder? Obviously, we're not asking you when token, if token, none of those things. But when you consider what the implications are for going with a token or sticking and being a private company versus what we're seeing kind of in the public markets, how do you disseminate the best thing for your business? How do you distinguish when it's the right time to start to kind of share value with your network via an equity or a token, or reinvest those proceeds back into the business to fuel more growth?
Yeah, for sure. I mean, this is a classic question, perhaps like, we are one of the best suited to answer this, right? Like we're actually kind of like a public utility in some sense. The product, if you abstract everything away, is a commodity. You have if you take the entire insurance market, you get a beta of the insurance market, and it's kind of steady state, predictable. So here's how I would posit it, right? Like the beauty of re is that it emulates what exists and what has found a market solution after 350 years, right? So Lloyd's of London has a governance council, right? It dictates who can transact on that market. It dictates the common capital layer that supports the entire market. It sets the fees. It sets the lines of business. It sets expansion goals. There is a direct real world analog to what we are attempting to do on chain that has taken hundreds of years to get to where it is, right? And so the beauty of it is we're not starting from zero. We're literally taking that as, hey, here's the fee setting mechanism. Here's how value is accruing to the common capital pool. Here's how we align economic incentives. Because if you're originating any sort of risk, whether you're a lending business, whether you're an insurance business, what you want to be sure of is people aren't cramming crap in the front door, right? And you want to be sure that people who are originating that risk are also aligned economically with the folks who are ultimately taking that risk. And so similarly, what capital they need to post, right? So that there is this common enterprise kind of idea that's happening here, right? And so it's a good time, generally speaking, in the reinsurance market still, right? Our return on equity for like a general reinsurer is sitting in the high teens, low 20s, which is quite good. You know, we haven't seen significant capital destruction over the course of the last couple of years, especially in the catastrophic realm. Our business is very, very low volatility. So if you think about what we do and why we've approached the market the way we have, we know DeFi gets spooked. We know that people don't want their capital destroyed. We know that people want safety. And so we're more of a law of large numbers business. All of the hundreds of thousands of policyholders are in low limit, low volatility lines of business, very little catastrophic to negligible catastrophic risk. It is purely these small policies where, as time passes, no individual claim is going to move the needle for us too much. And so we sit on the lower margin end of kind of this market, but the trade-off is we trade off upside for downside protection. And currently, like, that's the right configuration for DeFi. Eventually, it'll change by governance, but that's where we're at.
And then, Karn, if you did decide to kind of take this common pool of capital, right, there's a very, as you said, well-documented historical business of reinsurance and how the allocation of the capital happens. Introducing this on-chain adds that transparency, adds that, credibility for 24/7 reserve management, 24/7 transparency reports. If you were to think about how you would want to extend this business even further on chain, then you start to get into this token conversation, into kind of like how you think about further expanding more value for your customers, for your clients, for your business. Rob's kind of asking how you're thinking about allocating the capital. People are very excited about like token buybacks right now from the hyperliquid perspective. They're excited about making these assets kind of like more on the deflationary realm in terms of like the amount of emissions versus the amount of revenue kind of flowing in. People are just wanting to have a well-rounded business behind the asset they're investing in and then know what they're investing in.
For sure.
So you guys got the well-rounded business thing dialed. Mm-hmm. What is the potential asset that we can invest in for RE protocol? You guys are at 400, about 400 million now. Say, you guys get to 4 billion, 10 years, 5 years. People want a part of the upside. You want to have this kind of growing distribution, this growing community. How do you do that right? What's going through your mind?
Yeah. So I'm firmly of the camp, generally speaking, that if you are high growth, right, and if you're growing like 3x, 5x, 6x year over year in your venture scale business, it doesn't behoove you to do things like throw the capital back out the door, right? Like what you're doing is you're trading off like a very high, outcome potential opportunity for the vested stakeholders for something that's just cash in hand. And, that would imply lower general overall multiples for the type of stuff that, should exist or is happening on chain today. And so as long as you think, and this is not a re-specific thing, but if you think of this as a founder, right? If you think that you can continue to add value and grow at a clip and generate an ROE that is well in excess of what the market can deliver, then you should continue to pile in. Not only should you just do that, you should tell the story and back up the story with the numbers, right? Like if you're growing 5 or 6x year over year and you're spinning off hundreds of millions in free cash flow, it's a good story, right? Yeah. And you can take Re as a stylized example of that, doing hundreds of millions in top line. And then you can take a look at reinsurers that are spinning off billions in free cash flow a quarter, right? If you think about like, if we were to decide like, hey, there's a switch here, or governance to decide there's a switch here, there's buybacks, there's a huge amount of capital that's available to be able to do that kind of stuff, right? Well, whether it's prudent is at that point in time is ultimately a decision you need to make that says, hey, what's the growth track of the business? What are the potential opportunities? And if it makes sense and it's prudent to return capital, you absolutely should as an operator, right? But that is like on a case-by-case basis and depends on kind of what your growth track is and whether you believe you can continue to generate value That's it.
Yeah, it makes sense. And you know what I think? I think honestly, Andy's projection is a little is FUD. 4 billion in 5 to 10 years. It feels like the multiples here are such that we will see a liquidity effect where liquidity begets liquidity, and there's a coordination of capital that ends up coming on chain, and it ends up bolstering the reinsurance protocol. And when it comes to everyone who's listening and they want exposure to this uptrend, and maybe they're not in a position to participate in venture capital. You guys aren't raising another round, and so this ship has already left the station. But you mentioned how the reinsurer businesses are spinning off so much free cash flow. We had one of our friends of the show, Santiago Santos, who's kind of doing an inversion capital, looking to buy companies and implement blockchain technology in a more private equity fashion to kind of bolster those businesses. That's effectively what's happening here with reinsurance. And we don't necessarily need to get direct exposure to the asset itself. What we can do is we can look at the reinsurance business as a whole. We can look at some of those companies that are maybe public or out there in the liquid market, and we can anticipate that they will start to adopt this technology that will improve their bottom line because it'll cut their expenses. They'll be able to make their businesses so much more efficient. And those will be the liquid assets that our audience can take exposure in. And so I guess my question here is, if I'm a reinsurance business, the Lords of London, right? I've been operating the same way for 150 years. All of a sudden, there's this newfangled blockchain technology, and Karn knocks on my door. He says he's got 400 million in business. What is my incentive? What can I expect as a reinsurance business as the improvement to my bottom line? What is the elevator pitch to these businesses that have been operating the same way for a century? Is it you get in there and you say, hey, we can improve your margins by 10, 15%? Generally, what is the pitch to these reinsurance companies to bring them on chain?
Complete transparency and cash collateral, which is not something not every insurer can offer. A lot of it is we signed a piece of paper and we said we're good for it. Let's see you in 5 or 10 years, right? Instead, what you have is a direct visibility into exactly the capital is backing the promises that have been made. But I wanted to step back a little bit. The analogy I want to draw here is if you think about it as a product, right? Tesla went out and they found a way to print cars at the highest gross margin, kind of marginal cost profile possible. What I'm kind of viewing this as is I have a product of reinsurance, and there's really 2 components to that product. It's what's the OpEx and expense load that's necessary to generate this product, and it's the lowest it possibly could be by a technology-enabled company like ours, which has dozens of employees as opposed to tens of thousands of employees, and a unique capital source or cost of capital that provides it with an edge over time, right? And if you think about these slivers of insurance risk that are going to find their way out into the broader DeFi market, into vaults, into all sorts of different strategies, people are doing all sorts of unique things. As they become a much more predictable source of yield and people are starting to rely on them, you ultimately see a decline in cost of capital through convergence and integration. And something that that's something that no reinsurer in the world can compete with. What we're arcing towards is producing the product of reinsurance at the lowest possible cost. If it's the lowest possible cost, it either benefits the policyholder or benefits our counterparty, the insurance company that's going out into the world and selling insurance. And let me tell you, they care about money, right? They absolutely do. And so if you're coming to market, you're faster, you're quicker, you're clearer, and you're cheaper, that's a really difficult thing to compete with.
Yeah. Karn, last thing from us. What is the next 6 months, 9 months for you guys? We're almost halfway through the year. It's freaking crazy. It's already June. It's flew by. Wow. What can we expect, right? People that are watching the show are in the community. They want to be a part of, high growth projects, companies. They want to track you guys. What can we expect kind of throughout the rest of the year into next year? What are your big goals and targets?
Yeah, for sure. I mean, look, we've kind of said this publicly in the past, but our Jan 1, 2027 goal is to hit $1 billion run rate, right? $1 billion in premium. That's meaningful. That takes us out of startup territory, out of probably at the upper end of the scale-up territory, and from there on in, it just comes down to hey, integration into DeFi, general, we've kind of conformed to all the liquidity needs of folks who are operating in DeFi. This product now kind of exists. There's a track record. We see capital form. We write billions and billions in premium, right? There's a real shot here that this thing just eats a meaningful part of the reinsurance and insurance market, right? Like, if you just take Lloyd's as a style example, as one market, it's meaningfully sized. But and there's a couple of equity analyst reports out, but if you just price Lloyd's, that's a $100 billion market, right? And that's one of many. So the size and scale of this opportunity is massive. It's like 12% of global GDP.
This guy, man. Everybody today has just been so bullish.
It's
Bitcoin's at 68K and everyone's so bullish today, Karn. Thank you for spending some time with us, man. Really looking forward to working closer to tracking you guys. Been big fans. And I think that the market is going to be caught offsides and off guard with the scale of what you guys are doing and kind of like the rigor and the kind of what is happening behind the scenes here.
Yeah, for the sake of our industry, thank you for quantifying the TAM in percentiles of GDP. I think this is a practice we should make more common. Yeah, and Karn, thank you so much for coming on, man. Hope you come back again soon.
For sure. Thanks, guys. Appreciate the time.
Thanks, Karn. Cheers, man.